Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to CEO Tarek Fadel and CFO Ian Flaherty of Fadel Partners, a leading brand compliance, rights and royalty management software developer. So welcome, gents.
Thank you. Thanks for having us.
Thanks, Paul.
Yeah, good. And big congrats on this morning's inline first half results, with sales coming in at $5.3 million. But before we sort of dig into the details there, Tarek, I don't suppose you could just quickly remind the audience what the company does, its sort of key USPs, and the really strong secular growth drivers behind the whole of the sector.
Sure, absolutely. So Fadel has been really focused on the brand licensing and brand compliance space for quite some time now. And within those worlds, we really offer different types of solutions for clients. One solution is on the rights and royalty management side, where we help some of the largest brands work and manage their licensing programs and agreements. Meaning all of the deal negotiations that go into intellectual property licensing. That intellectual property could be of any form: content, character properties, technology, patents, etc. Where there's also a monetization aspect of it. So if you're the IP owner, i.e. the licensor, you're expecting to license out your properties and then receive royalty payments. And then if you're a licensee on the other side of that equation, you're licensing in that intellectual property. You're typically doing something with it. You're creating new product offerings. You might be a merchandise licensee or a technology licensee, and you're using a tech in your own product. And then you end up owing a royalty payment once you have sales or subscriptions to your final product. And so we manage that ecosystem for both the licensor, the IP owner, and the licensee, the IP user. And we offer a royalty billing engine that kind of sits in the middle and understands who owes what to whom and what the calculations are. And why this is critical is that the calculations are usually quite complex. So the royalty agreements, the licensing agreements are usually complex in nature. I always say it's analogous to like a telco billing engine. It has to know all the different rates and the uses and the numbers of products you have and what plans you're on and things of that nature. So that's really what we do with regards to the rights and royalty platform. And there we're very much focused on several sectors within media, entertainment, publishing. So we do quite a bit of work with publishing, trade publishing, educational publishing, as well as consumer products licensing, in addition to high tech and gaming. So those are sort of the subsectors that we sell our software into.
And how much sort of like value would go across that IP, the IP management software platform? I mean, if you do sort of like, I don't know, in the first half, around about sort of $4 million, etc. What sort of like total gross value of royalties would there be over the platform?
Yeah, so collectively and only in the consumer product segment, our software processes north of $4.5 billion of royalty calculations annually.
Wow.
And so we, in consumer products, about 28% of the global consumer products royalty market on an annual basis basically goes through our calculation engines. Yeah. And so, we see a lot of transactions. That's a unique differentiator.
I guess you can't do that with a pencil and pen, can you?
You can try. The audit would be very fun, trying to audit what that looks like. But that's really, where we shine is that our ability to process millions and millions of transactions, sales transactions, to calculate these $4.5 billion worth of royalties, but then also providing an audit-proof platform. So if you're a licensor, you're able to determine if the licensees are underpaying or overpaying or selling out of compliance. So they might have a license for one product or one character, but they're reporting to you that they're selling another character or property. And so the system flags all of that through the royalty calculation process and matches it against all of the agreement terms that are in the license agreement. So we're helping automate, for both the licensor and the licensee, the calculation and payment process, but then also ensuring that we're lowering the risk of an overpayment or underpayment on both sides of the fence. And that's where really the major value is.
And then you've got
the other side of the equation is the brand vision set of products, which is still focused on the content licensing and copyright compliance space, very much so targeted in the context of marketing content. And so we work with some of the world's largest marketing brands, predominantly in the consumer marketing space. So think fast-moving goods companies, packaged goods companies, beauty, consumer health, so over-the-counter type medication, appliances. So it's a very wide range of sectors. What's common across them is that they all do and spend quite a bit of money on marketing directly to the consumers. And in doing so, they're involving high-end talent in their content creation, meaning high-end photography, high-end videography, brand ambassadors, whether they're athletes or they're musicians or they're movie stars or what have you, to represent the brand. And so that side of the house, we're very much focused on providing digital rights management solutions. And so those are a combination of managing all of the licensing agreements that go into the content creation process, but then also all of the rights and uses. So what can I actually do with that content, and where can I apply it? So can I use the same images and videos on social media and on websites in the following territories? Would I be able to use these images on billboard campaigns in London, but not in Paris or in the US, for instance, within these time ranges? So we give a very accurate view to help protect the brand on where and how they could use that content based on their licensing agreements for that content. And then we've added an ability to also track and police that content for them, so that once they actually do the digital distribution of the marketing content, we're monitoring it constantly for them and letting them know what's set to expire, when, what they have to do for takedowns. And we're getting a lot more requests for that type of policing and tracking from some of the world's largest brands. And what's interesting there is that it's also starting to push us in a direction where it isn't only just copyright compliance, but it's also brand compliance. And so, is the right logo being used across my partner websites? Is the right product packaging being displayed on my retailer and e-commerce partner sites, on my social media sites? Do I have a relationship with a brand ambassador that, even though it's still in play, that I need to disassociate from for whatever reason? And where can I find all the content that exists with this particular person that I just need to go and take down? Yeah. Those are all scenarios today that the brands wrestle with, where the people manually are trying to find the content. And with our tracking capability, you can now fully automate that process and just get a report of where all the content is, so that you can actually do the takedowns. So very powerful solution that's got AI all over it in terms of matching, finding, crawling, video matching, image matching, and now we're introducing in our Q4 release this year, audio matching within videos. And so we're able to detect the music that's actually in the videos and let you know who the licensing party is, so that you ensure that you have a licensing agreement, let's say with Warner Music or with Sony Music or Universal, before you actually distribute that content into the ether.
Yeah, and I'm guessing in terms of that sort of the brand compliance, it'll also prevent bad actors, criminals, and basically stealing brand images or the audio or the video, etc. I mean, we had a case with Taylor Swift at the start of the year, who was dating, I think, Travis Kelce off the Kansas City Chiefs, and they came to the Super Bowl, and they had about a month trying to protect their digital rights, because generative AI went absolutely bonkers with bad actors, sort of like taking it. And presumably, am I correct in thinking that for that type of application, or whether it was whether one of your clients might be needing protection from sort of like criminals, it would spot that across the net and how it was being abused?
Yeah, I mean, that's a very interesting use case. And we see generative AI as a huge opportunity for us because when you think about even how the brands use generative AI and where the content development world is going, all the companies want to lower the cost of content production. And many of the brands that we work with today have launched their own studios so that they can lower the cost of production. In the past, traditionally, they would do it through agencies, and usually it's a multitude of agencies. And so now they've launched their own studios. There's one brand we're working with that over the last 18 months has launched 6 studios around the world to just produce their own content. Where I think it's going to go next is as these Gen AI tools, especially on the video side, become better and better, you're going to be able to do a full production and right behind your screen without having to go to necessarily to a studio. And you're going to be able to ask it to insert specific talent into that video.
Yeah.
But you're going to need the license agreement. So it does not negate the need. Actually, it enforces the need for licensing because most of the better known Gen AI engines today, if you ask them to create an image or a video with a particular talent, it'll tell you need the copyright agreement associated to that.
Well, I saw you actually I saw you won some new clients. You announced them even today, 3 more. L'Oreal being one of them in the in that brand vision area. Can you just talk through that sort of demand picture and the conversion of the sort of pipeline into sales at the moment? Because you really are in a bit of a sweet spot.
Yeah. So we've just recently had more wins as well that we just announced today. And the nice thing about the announcement and the wins is that they're actually across the multiple product offerings. And so all within the context of the compliance side. But for instance, with L'Oreal, it's more around, they're already a digital rights management customer, and they've been a customer since 2017. And they use us globally in over 70 countries across 36 plus brands, where we manage the digital rights for their marketing assets. And we're talking north of 4 million digital assets in the system that have all these rights to be tracked. So now they've asked us to also enable our tracking technology so that we can actually monitor over 120 sites just for one of the countries that we're working with.
That's one country.
Yeah, that's one country that's going to actually in the near future going to be going up to 250 sites that we're monitoring for them. And those include a combination of their own websites as well as the direct-to-consumer sites as well as e-retailer sites. So a company like L'Oreal, for instance, the largest beauty company in the world, does a lot of transactions on retailer sites and e-commerce. And so they have a huge digital footprint. As you have a huge digital footprint, you need to keep track on, where that content is and is it compliant or not. So we embarked on that project with them. Next steps are to go into other countries. So France, UK, are next logical. Spain are the next logical ones going into Q1 of 2025. So it's just expanding the offering at an existing site. Another win has been with the American Hospital Association, which is a really unique application of our rights and royalty capabilities because they license hospital codes. And so this is an organization in the US that is responsible for working with all the hospitals across the country and licensing hospital codes, hospital standards, guidelines, etc. And all these hospitals actually need to report to them on a quarterly basis, a part of their revenue that they're making from, let's say, beds, for instance, in the hospital, and they owe a royalty for that because they're following their standards. And so they have over 250 plus licensees that need to report on a periodic basis. Usually it's quarterly, and they wanted to enable self-service reporting for the licensees, but also all of the self-service accounting that happens in relation to those royalties that are being processed. So they just selected our platform. We took the same platform that we typically would sell to a consumer products licensor or to a high-tech licensor. It was just configured for medical billing codes. That's one of the unique value propositions of our software too. It's very highly configurable as opposed to having to customize it for each industry or each client. And therefore you can just, configure your settings as a business user as opposed to as a technologist, and then make that show what type of license agreement that you're dealing with and what type of royalty calculations that you're dealing with. So we're very excited over that one. And that's a multi-year agreement as well. And we've also back in March, April timeframe, launched a mid-market edition of our licensing software. Same technology, but just pre-configured to match the mid-market needs on the licensee side. So these are consumer products licensees, thousands of them, that have to pay up on a quarterly basis, calculate and pay royalties to their large licensors. So think licensees of Disney and licensees of Hasbro and Warner Brothers and Sony and Viacom, etc. So we built a pre-configured multi-tenant offering called Licensee that effectively allows them to manage their agreements, calculate royalties, and out of the box be able to submit statements in the required formats to these licensors. And it's a high volume, quick turnaround implementation cycle, etc. So we're on to our third licensee win for the year since March. We have several others in the pipeline for the year. We've gotten very positive reception from the market as it's a newer product offering for us. And as we're going down market, I would say we're sort of in this 6 to 8 months learning phase of pricing, what to accentuate in the sales process, how to get the deal done, maybe offering a slightly favorable payment terms because we're selling to a smaller customer base. And so we have a lot of learnings that we're going through right now, but we also have a very incredible pipe that's building up that's very encouraging for us. So we know we're onto something big, and now it's just how do we take that and amplify it in going into 2025.
Fantastic. Okay, good. Let's move to the financials, Ian. And I suppose you could quickly take us through the sort of the key highlights for the numbers on the sort of the revenues, the ARR, sort of gross margins, cash, and sales recognition.
Sure. Happy to, Paul. So for half one 2024, we closed the period with 5.3 million of revenue compared to 5.4 million of revenue in half one of 2023. Comprised in that number, license, subscription, and support revenue represented 3.4 million compared to 4.3 million for the same period in 23. Just as a reminder on that decline, during half two 2023, certain clients transitioned to self-hosted environments. Under the RevRec guidance of ASC 606, that shift in contracting structure and hosting structure caused a change in revenue recognition, where previously those clients had been amortized over the full year period. They actually transitioned to upfront revenue recognition in half two of 2023. So what that means for 2024 is all of the annual revenue recognition related to those clients will occur in the second half of our annual year, which is why you see an increase in RevRec for our projection for 2024. Half two 2024. From the services side of the house, 1.9 million of revenue in half one 2024 compared to 1 million half one 23. Really positive signs in this area. A lot of regional rollouts occurring with our existing client base, plus incremental projects with new clients that we signed during half one of the year. I think you probably also saw that we introduced ARR as a new metric in our interim reporting this year. From a management perspective, this is what we're focused on, growing that reoccurring portion of our business. Looking across the board, our IPM product grew 3% in the first half of 2024 from when we started measuring this. There's no logo churn on the IPM side of the house. We did add 2 new clients to that base, so we expect to see continued growth there going forward. Brand Vision came in with 33% ARR growth in the 6-month period ended June 30th. Again, 2 new customers with no logo churn for that client. And then PictureDesk actually decreased 31% in the first half of the year. That's largely driven by one large client that we had churn early this year. This was, the PictureDesk product is primarily comprised of a lot of small clients averaging $5,000 to $8,000 per year in license revenue. This specific client is a larger one that was on a private instance of our cloud, and that churn drove that 31% reduction, roughly $300,000 of annual ARR for that client.
Does PictureDesk compete with people like Adobe? Is that sort of like the bigger sort of like competitive landscape?
Not really. It's more of a media aggregator.
Right.
So it's a cloud aggregation platform of content. It's less digital asset management system, if you will. But the premise behind PictureDesk is we're working with mainly media, magazine publishers, news publishers, broadcasters who have a lot of content that they might need to either use and publish relatively quickly and or republish in the future. And so its main premise is to be able to index and quickly help you find a lot of pieces of content in the context of an editorial process. So the Adobe, systems, for instance, can integrate to PictureDesk and use it as a content source. But it's not directly competitive with the large dams.
Yeah. It seems quite unusual that, because I mean, you 18 years already, you've had a sort of like you've hardly ever had a customer decide to leave, isn't it? I was just trying to understand why it occurred. Very unusual.
Yeah, it's so the market in that space is evolving quickly, and in that space meaning in the media asset management space. And so there's quite a bit of newer vendors that have entered the market and over the last 5 years. Also the advent of newer AI engines and technologies. And what we've seen is, and in this case, it was one particular large churn, unfortunately, happened to be the largest client, but that's sometimes how it happens, right? Effectively just decided to move to a local provider that was providing similar AI type visual searching capabilities for now what is less than half the price.
Right.
And so, yeah, that's I think it was on the longer term, it's a lesson for us in terms of where should we also be priced at, because the technology sector has caught up in the AI visual searching space. So some of the unique value props of what used to be unique value propositions for the PictureDesk platform, the market has caught up. And so one of the things we're looking at now is building on top of the scalability and security of the platform, because there's still quite a bit of opportunities, especially in the magazine publishing world, where it's still a lot of images, less so videos, but a lot of images where there's still on-prem solution providers. And when we package our offering in the cloud, we have a very compelling ROI story for the publisher, who's already dealing with higher costs of print and higher cost of content, etc. And that's to simply just take away all of the legacy software as well as the legacy hardware associated with all that storage. So here, when you're talking about 50 million to 150 million images, for instance, and needing to search that within a 2-second response time, there's a lot of processing that's entailed. There's a lot of indexing that's entailed. There's a lot of storage that's entailed. So one of the benefits we can bring to that is we can just put that all in cloud for you, and you don't have to deal with any of it. And you just pay us a license fee basically to manage that for you. So that's one thing that we're pushing forward on. The other that we're really interested in doing is also bringing in short form video management and distribution into the platform. And so as we work closer with magazine publishers and then broadcasters, there's a use case around being able to bring in short form video into the platform, be able to index it, find it very quickly, but then also be able to distribute it to digital channels. So my TikTok site as a news publisher, my Instagram site, my app, my website. And how do I basically manage to say, this is the actual short form video that I do want to distribute, and then get it distributed through different formats. So that's something that we're actually looking to enhance in the platform moving forward, in terms of just uniqueness to the feature functions.
Okay, so just now returning to the financials, Ian, I don't suppose you could just quickly take us through the sort of the gross margin in the first half and how it's going to recover in the second, and likewise the sort of the the cash position and your sort of level of confidence in terms of the visibility to hit Cavendish's estimated sales for H2 of $9.5 million.
Sure thing, Paul. Yeah, so gross margin for the first half of 24 came in at 53%. That's compared to 50% for the first half of 2023. As you mentioned, with our heavily weighted half two revenue recognition, that does bring a bounce back of margin for the second half of the year. So we are projecting 65% gross margin for the full year 2024. Included in our gross margin for the first half of the year, license gross margin came in at 48%, down from 65%. Again, that's largely driven by the timing of revenue recognition, not necessarily any significant change on the cost side. From a service margin perspective, we came in at 61% for the first half of the year, a significant improvement over the prior year. And again, that's driven by the return of significant level of utilization for our services group in 2024.
And then just on that visibility for the rest of the second half, I mean, I did see in the outlook statement that you're hoping to be EBITDA positive in the second half, not for the whole year, but in the second half. And as I say, Cavendish have penciled in $9.5 million for revenue. So I'm guessing you've got pretty good coverage of that already.
Yeah. A large component of that revenue recognition relates to existing clients. Just due to the nature of our business and timing of when we signed original deals, a significant portion of our clients renew during Q4. Those conversations are underway, progressing well. We're not expecting any negative surprises there. So we're feeling pretty good around the 9.5. And as Tarek mentioned previously, we also have a significant pipeline of new deals across all product lines that we are highly optimistic will close during Q4, helping to contribute to that revenue growth. And just for clarity, the 9.5 million for Q4 24 is only a modest increase from the 9.3 million we did in the 9.5 for half two 24 is only a modest increase from half two of 23.
Yeah. And then just sort of like, I know there's no estimates out for 2025, but given you're sort of like within touching distance of getting EBITDA sort of break even, what sort of like level of revenue would you anticipate to become sort of like, cash flow and EBITDA positive for, sort of like going forward?
Yeah, well, keep in mind that a lot of the deals that we've signed and plan to sign for the remainder of 2024 will only have a partial year revenue impact. Anticipate those will provide a full year revenue impact next year in 2025. So that will contribute to our path towards break even. Based on our current pipeline and sales flow, we see increases in top line growth from an ARR addition perspective in 2025. At the same time, we're also, being very conscious on our spend. We're being cautious in a number of areas. We've learned from, trial during half one of the year on where to put marketing dollars, where to put sales dollars to drive the best impact. So we fine-tuned that process to kind of bring expense in line with the revenue generation we expect to achieve next year. So, we feel like we have a very clear path to EBITDA break even for the full year 2025. The exact levels of, revenue growth and cost control that we'll use to get there, we're still working on finalizing.
Okay, yeah, and I guess it also depends on sort of like how much you decide to invest in the business, isn't it? Sort of all the cash you're generating, how much you want to put into it. Okay, let's just move to another area, Tariq. I know the business has got a presence in Lebanon, and you mentioned in the statement that you've got an office in Beirut, and I don't suppose you could just quickly talk through that and the resilience of the business and what you're planning to do, or you've got contingency plans.
So, we've been obviously very focused on contingency plans for quite some time now. As we know, the troubling part started back in October. So we've been very much so focused on how do we, one, keep employees out of harm's way, but then two, continue to be operational around the clock because we have dependencies from clients on our staff there. So we've done a few things that seem to have worked out well. One is we launched a secondary office in Amman, Jordan, where we've already staffed it with development and QA and support staff. A little under 14 people, I believe, at this point are there. And those are local Jordanian resources. By the way, we found a great talent pool there that is very, highly educated and very technically skilled. So it's been a good, pleasant surprise for us. The other plan is that we've actually moved some people from the Lebanon office to the Jordan office as well across multiple disciplines. And we do that periodically in terms of just the relocation and cycling through so that employees have a chance to work somewhere else, but then also are sharing knowledge with their Jordanian counterparts. So we lower the ramp-up cycles of the knowledge. The third we're in process of doing actually very soon is also opening up a secondary office in the northern part of Lebanon, which is about an hour and 20 minutes north of Beirut. And the plan is to actually have a secondary office location that allows people that are commuting from that part of the country to our main office to Beirut to shorten their commute cycles and to be reporting to a local office. Again, with one, keeping employee safety in mind, and then two, ensuring that operationally there's always an office that's available with the right skill sets to be able to answer support tickets, be able to respond to clients, continue the R&D work. Another measure we have also taken is we have, this is very common to many Lebanese citizens, but a lot of them have dual nationalities. And so people who have dual nationalities who are able to travel have been asked to do so. And this actually started several months ago. And so we have people who are originally reporting to the Beirut office, but are now working from Montreal, London, Paris, Qatar, Dubai, Abu Dhabi. So we've also spread effectively the resilience and the ability to respond and the risk, if you will, outside the country completely. So we're working across multiple fronts. One is internal contingency plans. The other is external contingency plans. Knock on wood, but as they say, the office still hasn't closed a single day, the main office. We're a little bit in what they call the greater Beirut area, which is about 15 kilometers away from central Beirut, in what seems to continue to be a safe zone from the trouble. And the office is open and people are reporting to the office. We do have some employees who actually live in the trouble spots who have actually now relocated over the last few weeks. And luckily, I'm happy to report that everyone is safe and sound and is reporting to work.
That's good news.
Despite all the horrific news that we're seeing.
Yeah. And I'm guessing, given you've also, given you've won so many new clients, the capability of onboarding those new clients and getting the implementations, that's just business as usual.
Yeah, I mean, we haven't been impacted at all from our product releases to the client support to our SLAs, in terms of response time. And I think that's a combination of just the resiliency of the team, that's there, but B, that we've also have others across the company in the multitude of offices and countries that we just mentioned that are also part of that team. And so, we're able to operate across multiple time zones to ensure that our SLAs are being met, but also not just from within country, but also outside country.
Yeah, I'll send all our best wishes to your employees. I know the investors will have the greatest sort of sympathies and
Thank you. It's a difficult time, it's a difficult time in the world, I think. But so far we've been, on top of it. So and we obviously plan on continuing to do so.
Good. Okay. Well, let's just move now to sort of like go forward then on sort of the news. And I don't suppose you could just give us a quick, we've got when the trading update might be. And also, I know the last time we spoke, we talked a bit about the sort of the Reg S status, when we're going to be hopefully lifting that from the actual shares so that you're basically allowed to then go onto platforms like Hargreaves Lansdown.
Sure thing. Yeah, our next trading update is scheduled for mid to late January, following the close of our full year 2024. In regards to Reg S, on a positive news, we've passed our 1 year mark since IPO and stock issuance. So we have worked to remove our Reg S restrictions, which went into effect in August of 2024. So now folks should be able to access our shares directly through Hargreaves Lansdown and others.
Excellent news. Okay, then thanks very much, gents. Just before we finish, though, Tarek, I don't suppose you want to just give a quick few messages for investors, how you're sort of shaping the business and how you see it long term. Because I know last time we spoke, you've got, you're going to do well. Cavendish has got $14.8 million for the full year, but you were sort of like hoping in sort of 5 years' time you're going to be hitting full of 50 mil.
Yeah. So we are still very bullish on the business and the potential of the business. I think what we've seen is this year is a combination of things. One is a ramp up on the sales team side. So post IPO, so over the last 16 months or so now, 17 months, we've ramped up a team of over 13 people between inside sales and marketing. Put a lot of processes in place, a lot of systems in place, a lot of training in place. And what we've seen is the ramp up curve really, and at least in our space, I would say, but not too uncommon for sort of the enterprise B2B space, is really between 6 to 9 months for a good rep to just really be fully ramped. And we're seeing that in our pipeline. And so that did take a little longer than we expected. Speaking to a lot of other CEOs and board members, I always get the chuckle, which is it always takes longer than you expect. But I think we're there now, so that's a good thing. I can see it in the quality of the deals that are in the pipeline. Still, the majority of them are large, blue chip, global in nature, 6 figures in nature, multi-year in nature. So in that sense, we're still very bullish on where we're headed. I think we also need to take into account, though, that this year we've seen a little bit of a slowdown in IT purchasing, and deals not going away, but just basically decisions being delayed. And a lot of the clients that we deal with are predominantly US headquartered. They're global, but they're US headquartered, and so we're seeing budgets freeing up now. I think there was a big question mark just at the macro level as to, especially in the US economy, whether we're going to go into a recession. So that was pretty much the first 6 months of the year. It was unknown whether we're going into a recession in the second half or not. And then the job numbers came out well. The Fed's on path to lowering interest rates. And now all of a sudden, everybody's talking about a soft landing. We're going to avoid a recession. Typically what that means for companies like us in the B2B software space is that as interest rates come down, there's going to be an ability for companies to do more projects. We saw this in 2018, 2019, where there was a big boom in terms of new projects. And as companies are comforted that there will not be a recession, at least in the US markets, and there might be a little bit of a recovery coming from China. So a lot of the brands that we're exposed to also have very large Chinese presences, right? And luxury, beauty, retail, etc. So I personally am very optimistic towards the global picture as to where it's headed. I understand in the UK, it's actually a little more optimistic as well than it's been over the last several years. So crossing fingers that also, continues to be the case, but we're starting to see it in some of the deal acceleration that, we were able to close in Q3 and are expecting to close in Q4. So still very positive and bullish on the business. We had sort of the macro factor and the ramp-up factor both at the same time. Doesn't take away from the need of what we're doing and for the value that companies are willing to pay for it.
Brilliant. Okay, well, that's a great positive place to end it. So thanks very much for your insights and your time there, gents, and look forward, hopefully, in touching base at the next trading update in January. So thanks again, guys.
Thank you, Paul.